This is not China attacking the dollar. It is China exiting a structure that no longer closes mathematically. By the end of 2025, United States interest payments are approaching $1 trillion a year, a figure now competing with the largest categories of federal spending. The reserve currency does not die because a rival becomes aggressive. It dies because its own success demands a level of debt issuance that eventually makes confidence impossible to maintain. What gets described as routine portfolio adjustment is often the first visible symptom of something deeper. A system doing what it was built to do. On December 19, 2025, the United States Treasury released a number that passed through the news cycle like background noise. China's reported holdings of United States Treasuries had fallen to $688.7 billion, the lowest level since 2008. In the language of television finance, this becomes a footnote, a rebalance, a tidy line in a data set. But the data set is not the story. The story is the direction. The story is that the world's second largest economy has spent more than a decade dismantling a position that once made it one of the largest creditors of the American state. That is not what an investor does when they are optimizing yield. That is what an institution does when it is managing exposure to a structural shift. To understand why, you have to step away from the daily drama of rates, speeches, and headlines. A reserve currency is not a trophy that sits on a shelf. It is a function. It is plumbing. It is a promise that the world accepts because it appears safer than everything else. Countries hold your bonds because those bonds are the cleanest collateral in the system. Banks price risk off them. Trade clears through them. Contracts assume they will remain liquid in every scenario that matters. That is what confidence looks like in practice. It is not emotional. It is operational. And that is where the paradox begins. A reserve currency must be abundant. The world cannot settle trade and store reserves in something scarce. So the issuer supplies it. At first, that supply looks like strength. More demand for your currency means more demand for your bonds. More demand means you can borrow cheaply. Borrowing cheaply feels like proof of credibility. It feels like the market endorsing you. Governments call it flexibility. Central banks call it stability. But abundance has a cost. The world demands more of your currency as global trade grows. To meet that demand, you issue more debt. Over time, the reserve issuer becomes the engine that produces the collateral everyone else uses. The system becomes dependent on your deficits, because your deficits are the source of the instruments everyone holds. So the reserve currency's success forces the issuer into a strange corner. You must issue more and more obligations to keep the world liquid. Yet the more obligations you issue, the more you make the promise harder to believe. The reserve currency is a confidence machine that runs on debt, and debt is the fuel that eventually breaks the machine. This is not new. It has happened before with different faces and different labels. The transcript you provided points to a specific historical mirror because it is unusually clean. Britain's pound sterling did not lose its status after a dramatic battlefield defeat. It did not collapse from a single scandal. It cracked under the weight of an arithmetic test at a moment when an external creditor simply asked to be paid in the one form of settlement that could not be produced on demand. In September 1931, after years of strain following World War I, Britain confronted the core vulnerability of any credibility regime tied to finite reserves. Foreign claims were larger than what sat in the vaults. The public heard a large number and assumed safety. The creditors did the division and saw fragility. A national bank run does not begin with panic. It begins when someone with enough size decides to stop trusting reassurance. The transcript frames France as the actor that tests Britain. Not as a villain, not as a moral story, but as a rational creditor responding to incentives. If you're holding assets that are only stable as long as no one asks for settlement, then the correct move is to ask early, not late. That is not hatred, that is risk management. Once the conversion request started, the truth did not unfold over decades. It unfolded over weeks. And Britain did what reserve issuers do when their credibility constraint becomes unbearable. It changed the rule. It suspended the gold standard. In public language, it was policy. In functional terms, it was default through redesign. Empires rarely admit they are defaulting. They simply redefine what repayment means. The reason that moment matters is not nostalgia. It is mechanism. The mechanism is that reserve currency status creates claims that eventually exceed what can credibly back them, whether the backing is gold in a vault or productive capacity in an economy. The system can run for a long time because confidence is sticky. People build careers around it. Institutions build models around it. Governments build alliances around it. But once the underlying arithmetic becomes visible to enough large holders, the system shifts from stability to acceleration. Now bring that mechanism back to the present. By the end of 2025, the United States sits under a debt load described in your transcript as roughly $38 trillion, with a debt to GDP ratio presented as historically elevated. Whether the precise ratio is debated or revised, the direction is the point. The cost of servicing the debt has climbed into territory that changes choices. Interest is no longer a line item, it becomes a gravitational field. When a state's interest expense approaches the scale of its core budget priorities, the state becomes less free. It becomes reactive. It becomes a refinancing operation with a flag. The transcript emphasizes an uncomfortable milestone: interest spending approaching, and in some narratives, surpassing defense spending. That is not symbolism. It is a sign that the state is paying the past before it can pay the future. At the same time, the reserve issuer cannot simply choose austerity without consequences, because austerity inside the reserve issuer transmits contraction outward. The world depends on the issuer's liquidity. Cutting deficits can tighten global conditions, triggering the very instability that pushes confidence lower. Yet expanding deficits to maintain liquidity increases the debt stock and raises questions about sustainability. The system becomes circular. Every rational choice inside one stage lays the track for the next stage. This is why the transcript keeps returning to foreign buyers. The reserve issuer relies on external demand to absorb the bond supply without yields exploding. When foreign demand softens, yields rise. When yields rise, interest costs rise. When interest costs rise, deficits rise. When deficits rise, bond supply rises again. In other words, once the loop turns against you, it is not a single problem. It is a feedback loop. The transcript's claim is that China has been stepping back from this loop, steadily at first, then faster. From a peak above $1 trillion in the early 2010s to $688.7 billion by late 2025. The claim is also that this is happening alongside consistent gold accumulation and alongside the construction of alternative settlement infrastructure. Taken together, those moves form a coherent pattern. Reduce exposure to the incumbent reserve asset. Increase exposure to the historically neutral asset. Build payment rails that can operate without the incumbent currency. That combination is why the behavior cannot be understood as yield hunting alone. Central banks do not behave like retail investors. They are not chasing quarterly returns. They are positioning national balance sheets for regimes, not cycles. If the transcript is correct about the timing, then the acceleration in 2024 and 2025 is not random. It is what institutions do when they believe a regime is shifting from slow burn to unstable equilibrium. None of this requires conspiracy. It requires incentives. If you are a rising power with large reserves, you do not want those reserves trapped inside a system that may demand you fund the issuer's deficits indefinitely, while also accepting political and financial constraints tied to that issuer's institutions. Even if the system remains dominant, reducing dependence lowers vulnerability. And if the system is approaching a credibility test, reducing dependence becomes urgent. So the question for this documentary is not whether the dollar collapses on a specific date. That kind of prediction is theater. The real question is more clinical. What happens to a reserve currency when its debt supply must keep rising, its interest cost compound, and its largest external holders begin to step away? At the same time, the world installs alternative pipes. Because once you see that mechanism, you stop watching the story at the level of personalities. You stop waiting for a single announcement from a central banker to explain the decade. You start watching the flows, the auctions, the holdings, the hedges, the quiet infrastructure that only becomes visible when a regime changes. In 1931, Britain's public was told the numbers were fine. The bank had reserves. The empire had prestige. The pound had history. The system had tradition. Then a creditor asked a basic question that the system could not answer. And the rule changed overnight. The United States does not run on gold a day. The constraints are different. But the underlying paradox is the same. A reserve currency must expand. Expansion creates claims. Claims become costs. Costs become doubt. Doubt becomes exit. Exit becomes acceleration. If that sounds abstract, it should not, because a reserve currency does not die in the moment people notice. It dies in the years when the incentives quietly make survival expensive, and when the smartest institutions begin to behave as if the ending is not a drama, but a timetable. In the next section, we are going to return to 1931, not to romanticize it, but to extract the sequence with precision. What changed structurally? Why each step looked rational at the time? How one decision created the conditions for the next? Then we will lay that sequence against late 2025, and we will identify the points where confidence stops being a belief and becomes a measurable threshold. Because if this is a declaration, not a transaction, then the important question is not what China says. The important question is what the system forces everyone else to do next. In the summer of 1931, Britain did not look like a country on the edge of monetary humiliation. From the outside, it still looked like the center of the world. Sterling still sat at the heart of trade. British banks still intermediated global finance. The empire still possessed geography that made maps look like propaganda. But reserve currencies rarely die when the street can feel it. They die when ledgers stop balancing in rooms the public never enters. The Bank of England's gold reserves were presented as proof of solidity. A number that sounded heavy, a number that sounded final. The problem was not the size of the number. The problem was the ratio. Foreign creditors held far more claims on sterling than gold could redeem if those claims were tested at scale. In the transcript, this imbalance is framed bluntly. Roughly 150 million in gold against claims that could reach several times that. Even if the exact conversion figures shift across sources, the essential mechanism stands. A fixed reserve constraint cannot support an expanding claim structure forever. This is what reserve currency credibility actually is, a belief that claims will not be presented all at once. A creditor does not need to destroy you. A creditor only needs to doubt you. Once doubt is rational, asking for settlement becomes rational. And once settlement requests begin, every other creditor has to make a choice. Wait and trust the issuer, or move first so you are not last. In 1931, France did not need to mobilize an army. It only needed to make a request. Convert our holdings to gold. If sterling was as safe as it claimed to be, the request would be routine. If sterling was not as safe as it claimed, the request would expose it. This is the uncomfortable truth of monetary power. The test is simple. It is often polite. It is sometimes bureaucratic. But it is fatal to systems built on confidence beyond capacity. The sequence unfolded in stages, each step rational in isolation and catastrophic in combination. The first stage was credibility by tradition. Sterling had been dominant for so long that its stability was treated as a fact of nature. That tradition reduced perceived risk, which reduced borrowing costs, which encouraged reliance on sterling even further. The second stage was war financing. World War I forced debt expansion on a scale that peacetime credibility models could not easily absorb. The third stage was constraint, and the gold standard bound policy to a finite reserve at the same moment debt service became heavier, which removed flexibility precisely when flexibility was needed. The fourth stage was economic deterioration. With global conditions worsening, Britain could not grow fast enough to outrun the burden. The fifth stage was external testing. Creditors began to demand conversion, not out of drama, but because the arithmetic invited it. The sixth stage was institutional capitulation. Britain suspended the gold standard. A rule changed. The seventh stage was re-ranking. Once the rule changed, sterling no longer occupied the same place in the global hierarchy. The replacement did not occur because the dollar was morally better. It occurred because the system needed a new anchor that could absorb the world's demand for liquidity and collateral. Britain's elite did not wake up intending to default. They woke up intending to preserve the system. Suspending gold convertibility was presented as survival. That was precisely the point. In reserve currency regimes, the act of preserving the domestic system often requires abandoning the external promise that made the currency dominant in the first place. Now, take that same staged logic and place it over late 2025. The United States is not tied to gold convertibility. The constraint is different. It is not a vault. It is a financing structure that depends on continuous absorption of bond issuance at yields that do not make debt service spiral. The United States supplies the world with the cleanest collateral, largely through Treasury issuance. That is one reason dollars remain central. Treasuries are the instruments that global finance uses as baseline reference. The world holds them not just for interest. It holds them because they are supposed to be liquid under stress, because they are embedded in regulation, because they are treated as the system's safest anchor. But the anchor is attached to a ship that has accumulated weight. The transcript cites United States debt near $38 trillion by the end of 2025, and interest costs approaching $1 trillion annually. Again, precise numbers shift with accounting conventions and timing, but the direction is what matters. Interest expense is rising quickly because a large debt stock is being refinanced into higher rate environments, and because the debt stock itself continues to grow. This creates a modern version of the 1931 constraint. Britain could not print gold. The United States can create dollars, but printing dollars does not erase the cost of credibility. If the United States monetizes too much of its debt, confidence in purchasing power weakens. If it refuses to monetize and yields rise, interest costs explode. The constraint is no longer metal. The constraint is the trade between solvency optics and currency credibility. Here's where the bond market becomes the equivalent of France's conversion request. In the transcript, the Federal Reserve cuts rates, yet longer-term yields remain stubborn. That pattern, when it appears, is often read as the market signaling that policy rates are not the only variable. Traders price inflation risk, fiscal risk, and supply risk. When supply is heavy and buyers are less eager, yields do not fall just because the central bank wishes them to. The market demands compensation. That compensation shows up as higher yields, which then feed back into government interest expense, which then expands deficits, which then expands supply. That is the loop. And it is not political, it is mechanical. Now bring China back into the frame. China is not the only foreign holder, and foreign holdings are not the only source of demand, but as a large, patient holder, China matters because it represents what long-horizon institutions think about regime risk. The transcript's data point, $688.7 billion in Treasury holdings, is not important because it is smaller than the peak. It is important because it is a revealed preference. It signals a shift in how China wants its reserves structured, and the transcript pairs that with gold accumulation and alternative settlement infrastructure. This matters because gold is not purchased for yield. Gold is purchased for independence from the liabilities of others. It is the asset that functions when confidence in paper claims deteriorates. When a central bank accumulates gold persistently, it is often hedging regime change risk, not chasing a price move. The payment infrastructure claim matters for the same reason. A reserve currency regime is not just a symbol. It is rails, it is clearing, it is network effect. If alternative rails become usable at scale, dependency weakens. The world may not abandon the dollar quickly, but it can reduce exposure at the margin, and regimes are lost at the margin first. This is why the 1931 parallel is not about nostalgia. It is about understanding how exits begin. They begin while the system still looks dominant. They begin while officials still speak in calm language. They begin while media describes it as routine. They begin when the institutions with the most to lose decide that it is safer to give up convenience now than to fight for liquidity later. In 1931, the visible moment was Britain suspending gold convertibility. The invisible moment was earlier. It was the moment creditors decided the ratio did not work. In late 2025, the visible moment is a Treasury holding report that can be framed as a footnote. The invisible moment is the one implied by the pattern. A rising power looks at the debt trajectory, the refinancing calendar, and the interest cost curve, and concludes that holding too much of the incumbent reserve asset is no longer a neutral position. Once that conclusion is made, the rest is not ideological. It is a schedule, and that is where the story becomes claustrophobic. Because when enough large holders move in the same direction, even slowly, they create the conditions where the issuer has to respond, not with speeches, with balance sheet actions, with policy trade-offs that reveal the constraint. Britain's crisis did not begin the day the pound fell. It began when the system stopped being able to answer a simple question with confidence. The next section is where we quantify the modern version of that question, not with slogans, but with refinancing needs, auction dynamics, and the point at which the market stops treating Treasury issuance as background and starts treating it as a risk that must be priced. Because in reserve currency regimes, the end is rarely announced. It is priced. What changes a reserve currency regime is not a speech, it is an auction. A government with a reserve currency does not pay off in what is tough its debt in the way households imagine paying off a loan. It refinances, it rolls. Old bonds mature, new bonds are issued, and the system stays stable as long as the market can absorb that issuance at yields that do not turn interest expense into a runaway variable. This is why the transcript keeps returning to a single number that sounds mundane until you place it in context. A refinancing calendar measured in trillions is not just an accounting detail. It is a repeated test of demand. In Britain's case, the test took the form of convertibility. People could present sterling and ask for gold. In the United States today, the test is more distributed. It happens through buyers at Treasury auctions. It happens through yields on the secondary market. It happens through the willingness of institutions to keep treating Treasuries as the cleanest collateral even when supply expands and fiscal paths look heavier. The mechanism is subtle because it hides inside normal operations. A Treasury auction can succeed while still delivering a warning. It can clear, but only at a yield that is meaningfully higher than expected. That higher yield is not a headline to most people, but it is a message to anyone who understands what the issuer must do next. Higher yields raise the cost of refinancing. Higher refinancing costs expand deficits. Larger deficits increase issuance. More issuance tests demand again. Once that cycle turns, the system begins to feel like it is running on its own inertia. This is where the transcript's claim about interest expense becomes central to the story. A large debt stock combined with higher rates creates interest payments that compete with major federal priorities. Whether the exact number is $970 billion or a slightly different figure depending on timing, the direction is the stressor. Interest becomes less like a bill and more like a force that crowds out discretion. When a state spends a rising share of revenue servicing past borrowing, it becomes less able to respond to shocks without borrowing more. That is the trap. The solution becomes the accelerant. This is also why the Federal Reserve sits inside the narrative as a constraint, not as a villain. Central banks are tasked with maintaining monetary stability, but the reserve issuer's central bank is also the backstop of the government bond market in extreme conditions. In normal times, that backstop is a comfort. In late-stage conditions, it becomes a signal. If the central bank must purchase government bonds to maintain orderly markets, then the world must ask whether those purchases are temporary liquidity operations or the start of debt monetization. That distinction is not philosophical. It is credibility. If bond demand weakens and yields rise too far, the government's interest expense rises sharply. In the transcript, the claim is that even modest yield increases can translate into very large annual interest costs once refinancing needs are large enough. That is the point. At scale, small changes become structural. A half point in yield is not a half point in cost. It is a half point applied across trillions of refinancing. When the debt stock is enormous, the sensitivity becomes dangerous. But the issuer cannot simply force yields down with policy. The policy rate is one part of the curve. Longer maturity yields reflect expectations about inflation, fiscal trajectory, supply, and credibility. This is why the transcript emphasizes a phenomenon that can look paradoxical to non-specialists. The central bank signals easing, but the market does not reward it with low long-term yields. In a late-stage reserve regime, the market can interpret easing as confirmation that the issuer cannot tolerate high interest expense, which can itself raise the perceived risk of future monetization and inflation. The act of trying to reduce pressure can become evidence that pressure is real. Once you understand that, China's behavior sits in a different light. The transcript frames China's sales not as a sudden tantrum, but as a multi-year repositioning that is accelerated. That matters because it is consistent with how large institutions manage regime risk. They do not announce they are worried. They reduce exposure. They shift toward assets that do not depend on the issuer's promise. They build optionality. Gold plays that role in the transcript, not because gold pays income, but because gold does not require confidence in another state's fiscal path. The transcript also points to alternative settlement infrastructure. Again, the importance is not that such systems instantly replace the dominant rails. The importance is that the existence of functional alternatives reduces the penalty for stepping away from the incumbent system. A reserve currency is powerful because it is convenient and because everyone else uses it. The first crack appears when convenience stops being exclusive. This is where the story becomes about thresholds, not predictions. Most of the time, reserve currency transitions do not occur because a single actor decides to flip the table. They occur because multiple actors independently decide to reduce dependence. Each actor's move is rational by itself. Together, they alter market structure. Liquidity becomes thinner. Volatility increases. Risk premia rise. Then one stress event arrives, and what had been gradual becomes fast. Britain experienced that acceleration. The years of strain were long. The breaking moment was short. The United States could experience the same pattern without an identical trigger. The trigger might be a cluster of weak auctions. It might be a geopolitical shock that raises inflation risk. It might be a domestic political period that makes fiscal direction less legible. It might be a global recession that reduces risk appetite and increases demand for liquidity. At the same time, the issuer must borrow more. In each case, the system is pressured in the same place. Absorption capacity. And this is the most important shift in perspective the viewer needs to make. Do not ask when the dollar collapses. That is a dramatic frame, and it encourages the wrong kind of thinking. Ask instead when the system begins to require increasingly extreme interventions to keep auctions stable and yields contained. Ask when the world begins to price treasuries less like frictionless collateral and more like sovereign risk that must be compensated. Ask when the central bank's balance sheet actions begin to look less like temporary crisis management and more like permanent support. Because once that threshold is crossed, the reserve currency does not vanish. It decays. It becomes less central. It becomes more contested. It becomes more expensive to maintain. The issuer can still have a powerful economy and still lose the unique privilege of issuing liabilities the world treats as unquestioned. That privilege is what made the system feel effortless for decades. It is also what built the paradox. If the transcript's framing is correct, then China's reduction towards $688.7 billion is not the end state. It is an intermediate signal. A large holder stepping away while building hedges and alternatives is the modern equivalent of a creditor asking for gold. It is a quiet request for proof. Not proof in speeches, but proof in market clearing. And proof in this system is always measured the same way, by who shows up to buy the next tranche of debt and at what price. There is a moment in every reserve currency era when the issuer discovers that confidence is not a feeling. It is a bid. The transcript gestures toward a critical idea that most coverage avoids because it sounds too stark. There is a level of selling, a level of diversification, a level of not showing up where the bond market stops behaving like deep water and starts behaving like a crowded exit. At first, nothing looks broken. Auctions still clear. Trading still happens. The currency still dominates invoices and reserves. The system appears stable because the system has always appeared stable until the weak does not. But late-stage regimes do not fail because the public suddenly panics. They fail because the marginal buyer changes. In early and mid-stage periods, the marginal buyer is a reserve manager, a pension fund, a bank required to hold safe collateral. A foreign central bank recycling trade surpluses back into the issuer's debt. They buy because the system is designed to make that purchase rational. In late-stage periods, the marginal buyer shifts toward investors who require a premium because they are not buying safety. They are buying yield. That shift is subtle at first. Then it becomes visible in the only place that cannot be coached by press conferences: the price. When yields rise, while policymakers try to project stability, that is not a scandal. That is the system revealing its incentives. A higher yield is a tax the issuer pays to keep the machinery supplied with buyers. The issuer can tolerate that tax when debt is modest. The issuer cannot tolerate that tax when the refinancing calendar is enormous. The transcript frames this as a tightening trap around the Federal Reserve and the Treasury, and the logic is hard to escape. If rates rise, interest expense rises. If rates fall too quickly, inflation risk rises and credibility can weaken. If the central bank buys debt to stabilize yields, it risks appearing to monetize deficits. If it refuses, it risks allowing yields to spike and debt service to accelerate. Every option has a cost, and in late-stage conditions, the costs begin to compound rather than trade off cleanly. This is the modern version of Britain's 1931 constraint. Britain could not print gold, and that was fatal when creditors demanded conversion. The United States can print dollars, and that changes the shape of the crisis, but it does not remove the fundamental problem. Printing can meet nominal obligations. It cannot guarantee that the value of repayment remains stable enough to sustain global confidence. In a reserve currency, nominal solvency is not the victory condition. Credible purchasing power is. This is why gold appears in the transcript like a recurring shadow, not as a commodity story and not as a retail investor narrative, but as an institutional tell. When a major creditor reduces exposure to the issuer's debt while increasing exposure to gold, the creditor is not chasing a chart. The creditor is preparing for a world where paper claims are questioned. Gold is the asset that does not require trust in another government's future tax base, political stability, or refinancing capacity. The transcript also frames the installation of alternative payment rails as the missing context, because selling alone is not enough. If you reduce Treasury holdings but still must settle most of your trade through the dollar system, your dependence remains. Diversification becomes meaningful when it is paired with infrastructure that can carry volume. This is why the mention of multi-country settlement systems matters, not because any one platform immediately dethrones the dollar, but because the existence of working rails lowers the switching costs that once protected the incumbent regime. Reserve currency status is a network effect. Network effects do not vanish. They erode. They erode when the network becomes less safe, less convenient, or more conditional. They erode when large participants begin to build parallel routes, even if those routes are initially slower and more expensive. In early phases, parallel routes are dismissed as inefficient. In late phases, parallel routes look like insurance. And that brings the story to the part that most people would rather treat as hypothetical. The point at which the issuer's policy response becomes a signal that the system has entered a different phase. In Britain's case, that signal was the suspension of gold convertibility. It was a line crossed, an explicit admission that the old promise could not survive the new arithmetic. The modern system will not use the same language. It will use technical language. It will use phrases like market functioning, liquidity support, temporary facilities, and targeted purchases. It will describe each intervention as narrow, prudent, and time-limited. But the market does not listen to adjectives. It listens to repetition. If interventions become frequent, confidence begins to shift from the issuer's fundamentals to the issuer's support operations. That is a different kind of credibility. It is the credibility of power, not the credibility of safety. And power credibility can hold for a long time. But it is more brittle than it looks, because it becomes vulnerable to politics and to inflation outcomes. The transcript implies that the most dangerous period is not a time when everything is obviously failing. The most dangerous period is the transition window when the regime is still considered dominant, but the incentives are already pushing major institutions to reduce exposure. That is when the audience should stop thinking in headlines and start thinking in stages. Stage 1 is complacent stability, where the reserve currency's dominance is treated as permanent. Stage 2 is slow diversification, where large holders reduce exposure while the system continues to function, and media describes it as routine. Stage 3 is acceleration, where diversification becomes more visible in holdings data, and where bond market pricing begins to resist policy guidance. Stage 4 is the liquidity stress phase, where issuance meets weaker absorption and yields begin to rise faster than the issuer can tolerate. Stage 5 is the intervention phase, where the central bank must act to stabilize the market, and the distinction between liquidity support and fiscal support becomes harder to maintain. Stage 6 is the credibility fracture, where the world does not abandon the currency, but begins to treat it as one option among several. Stage 7 is the re-ranking, where the currency remains important, but the unique privilege is gone. Notice what is missing. There's no single day when everyone agrees the system ended. There is only a sequence where each step makes sense until the sequence becomes unavoidable. That is the cognitive upgrade this story is offering. The viewer is not being asked to predict an apocalypse. The viewer is being asked to recognize how monetary empires unwind, how they protect themselves, and how those protections become admissions. If China's move is a declaration, the declaration is not a threat. It is a forecast of behavior. It says that a major institution expects the next stages to arrive, and it is positioning as if the price of waiting is higher than the price of leaving early. And now the most uncomfortable question becomes unavoidable. When the next stress test arrives, will the United States be able to clear its refinancing schedule without paying a premium that accelerates its own debt loop? Or will it be forced to choose between higher yields that expand interest expense and interventions that expand doubts about the dollar's purchasing power? Britain's September 1931 moment was not dramatic in its cause. It was dramatic in its implication. A rule changed, and the world quietly understood what that meant. The modern equivalent will not be a proclamation. It will be a pattern of auctions, yields, and interventions that tells the same story without saying it out loud. Because reserve currencies do not end when enemies declare war. They end when the issuer can no longer afford to keep proving that its promises are risk-free. The most dangerous myth in a reserve currency era is that dominance is the same thing as immunity. Dominance is often just a long period where the cost of doubt is too high for most participants to pay. Immunity would mean the arithmetic can never turn. History offers no such exemption. When China reduces Treasury exposure while accumulating assets designed for a world of weakening paper credibility, it is not announcing a date. It is revealing an internal calculation. It is saying that the privilege of holding the incumbent reserve asset is no longer free. It now carries a scenario risk that must be managed like any other. And once that mindset spreads, the system changes, even if the currency remains central. Because the reserve currency is not upheld by slogans, it is upheld by repeated willingness. The willingness of foreign holders to roll maturing debt into new issuance. The willingness of domestic institutions to absorb supply without demanding a destabilizing premium. The willingness of markets to accept that the issuer will protect purchasing power even when political and fiscal realities make that protection expensive. The transcript you provided keeps circling one idea because it is the true hinge. Confidence is not lost in a debate. It is lost when enough large players decide that the next bid requires too much compensation. That is when the reserve currency begins to feel the difference between being respected and being required. In 1931, the system broke when Britain could not satisfy the promise that anchored confidence. The world learned in a single season that tradition does not redeem liabilities. Capacity does. The gold standard suspension did not merely weaken sterling. It told every creditor that the rules could change when the issuer needed them to change. That is the moment the reserve currency becomes conditional. In the modern system, the rules do not involve gold. They involve the boundary between monetary stability and fiscal necessity. They involve whether the issuer can refinance at tolerable rates without turning interest into a dominant claim on future revenues. They involve whether interventions remain rare or become routine. They involve whether the world continues to treat the issuer's debt as the cleanest collateral or begins to treat it as exposure that must be hedged. This is why the holdings data matters more than the commentary around it. It is not a headline, it is a pressure gauge. It shows that one of the largest holders is already treating the system as late stage. And that is the final inversion the viewer is meant to carry out of this story. Do not watch for a dramatic announcement that the dollar is finished. Watch for the quiet accumulation of costs that make maintaining reserve status less profitable and more fragile. Watch for the point where preserving stability requires interventions that signal instability. Watch for the moment where the system keeps running, but only because the issuer is paying more and more to convince everyone that nothing has changed. That is how reserve currencies end, not with a funeral, with invoices. Once you see that, you begin to see the machine everywhere.